How to hedge the S&P 500, unique options play. Today, I want to look at a unique tactic you can use to hedge against a correction, a sell-off or worse in the S&P 500. No matter whether you think the market will keep going higher, or worry that we're about to lose 20% again. Today's idea will show you how to hedge your portfolio at the lowest possible cost and for the best possible gain. My first point. This week's content has explored current and future valuation for the S&P 500, hedging the S&P 500 as an investor, buying inverse ETFs for short-term gains, and the mixed message. We're getting across a breadth of market and financial data. Second, note that our focus is primarily on a short-term sell-off or correction in the major indexes, not a resumption of the bear market. Corrections are healthy and normal, so the question is, how can you use them to your advantage? Today we'll consider a variation on a put spread tactic using the SPDRs and P500 ETF, SPY. We'll use the SPY because traders of any account size can trade it due to its lower cost profile and because it has enough liquidity, volume, and strikes to support trades. Large portfolio traders can replicate this tactic with the SPX, but the cost differential is extreme. Let's identify key support, resistance levels in the SPY first. For more information on this trade idea and others like it, visit tradersreserve.com.